Okay, so I won't be doing stuff on the screen today because I can't get it to show. Okay, so on Wednesday, we were in the middle of developing something for the Excel spreadsheet, and I was planning on finishing doing that in the Excel spreadsheet, but since I can't get this machine to display on screen, nor can I get my laptop to display on screen, and I don't want to waste our whole time here today trying to troubleshoot, I'll just talk through what you need to do for 4.7, and then hope that you're able to get that. And if you have questions, you have the same equations as me, but you didn't get the answers that you wanted, we'll talk later. So for section 4.7, we got through the first 2 or 3 equations. The last equation that I wanted to talk about is when the government bonds became mature, and you got money from them. So what we had last time is we had some equation equals, that's not good.
I went to Jake and it's like, I don't want to go to Jake's.
We had some equation
Let's not go.
was our savings after year 3. And it took 3 years for the first government bond to mature, right? So what we want to do is we have our savings from year 3, and we are going to subtract off our how much our payment for that year, and then we get to add in $1,000 or G1 for selling that government bond back at its par price. Plus, we get the interest from that year before we were able to sell it back. So we could probably type this as 1.0675. G1 right there. Plus, we get the interest 0.5 off of our second government bond, and our interest from this savings right here. And all of that then goes into the savings for the 4th year. Right? And in our 4th year, we're not going to have any component here at all. Right? We sold these government bonds, so we neither get interest nor can we sell them a second time. Right? So we would just have our ability to sell these government bonds and get the interest from that last year of the government bonds. So it would be minus the price that we sold them for, that we had to pay, plus our government 2 bonds, our interest was going to be S5. And then S5, all we can do is the payment that we had to pay that last year. We're done making money off of these government bonds right here, but we still have to make payments, so that can only come from our savings right here. And that goes into our final savings value right here. Oh wait, and there's one more, isn't there? No, that's right. Right. Now, without even thinking about using a computer, what would you, if you were in charge of this company, what would you want this final value to be? How much extra do you want to have to pay? 0. So this is a good test for your solution. If this value right here is non-zero, then you know you put too much money in to begin with. Okay, so that's a way that you can just logically test to make sure that your equations make sense. Okay, there's a couple other ones. I think the savings for 3 and 4 end up being 0 because we're able to pay the full payment out of the sales of our government bonds, and so we didn't have to have any savings going into those years, if I remember the outcome correctly from that one. And so normally a zero would look really weird. Wait, we're not saving any money, where's it coming from? Oh yeah, it's coming from this. So you can just do, even if you don't know what the right answer is, you can look through those values and see if they even make sense at all. Okay? And this one's a real easy check right here. Then, I wish I had the numbers in front of me. Your textbook asked some really important questions, which were, what if we could reduce that last payment, which was $460,000? What if we could reduce that, was it down to $400,000? Right? What if we could do that? How much should we be willing to pay to reduce that last final payment down from $460,000 down to this $400,000? Okay? How do you answer that without like plugging in 400 into here and just seeing what your new savings amount should be? How do you answer that? I mean, how many of you did that? Just changed this from 460 to 400 and looked at how much savings you made? How many did something else? What did you do?
So I looked at the dual price, like how much it would benefit to reduce it, and then multiplied that by 600,000.
By 60,000, yes. Right, this constraint right here encapsulates that payment. And when we rearranged this, this became the right-hand side of that constraint, right? It became S5 minus X6 equals 460. And the shadow price specifically says, if we could change the right-hand side of a constraint, how much will we change our objective function? So that shadow price is directly related to this 460. So if we ask the question, if we decrease this from 460 down to 400, we can multiply our shadow price, which was something like 0.78. So you have 0.78 times 60,000, and that's how much you should be willing to spend up front, which is, if I remember my math correctly, approximately $47,000. Okay, so that's how much they should be willing to spend now to save $60,000 later. What does that sound a lot like to you, those of you especially who are business majors of some sort? Where we're willing to spend money now at a certain rate to get money later for a different value.
Net present value?
Yeah, it's exactly what it is. In fact, that shadow in this case, that shadow price, is the net present value of those different years. So that means that in year 6, the net present value of the dollar is 78 cents. So $1 now is only worth 78 cents later. Or I'm willing to pay 78 cents now to get $1 in the future, right? That shadow price has that exact meaning for that. So you can not just apply it at this last payment, but you can apply it to any payment in this thing. Oh, I know that I'm having a big research and development project that's going to come due, and I'm going to have to pay for its construction. I can't afford this payment here. Can I restructure it in some way, paying ahead, or I have a bunch of retirees that are just about to exit early, and I'm going to have to pay them extra money. Can I backload these payments? How much more am I willing to do for that? So it gives you this managerial understanding of not just we have this payment structure in place, but you have given these rates of these government bonds right here, and when they mature, exactly how much you're more or less you're willing to pay at any given period because of what its future value to you is, or its present value is to you now versus what it's going to be worth in the future. Okay, and so these shadow prices have that direct meaning. Another question your book asks is, how much should you be willing to go, was it from 190,000 down to 150,000, I think, right? In your very initial payment, right? What was the shadow price of that first payment? 1. So because there was no interest that you had gathered yet. So if you would be willing to pay up to $40,000 here to reduce that payment from 190 down to 150, which makes sense. Okay. Yeah, I think that's what I wanted to talk about with 4.7. Are there any questions that you guys had as you were working on 4.7 that I haven't talked about specifically? I'm sorry that the machine is not up and I can't go through it online. Okay, so let's start talking about problem 510 that was due for today. 410, sorry. Didn't mean to scare you. All right. So I'd say there is probably one tricky part in this problem that we didn't necessarily talk about to getting this totally right. So let's go through step by step again. Step 1, what's the first step that we do when we solve these problems? Define our variables. So what are our variables in this particular problem? Question?
Investment options.
What's that?
Investment options.
Investment options. How many of them do we have?
4.
4. And how are we going, this is very important, how are we going to represent these options?
Percentage.
What's that?
Percentage of total income.
Percentage of allocation is how everything is worded. It's not a dollar amount, right? We don't have a specific dollar amount that we have available to us. And one of the questions later on that the book asks you is, why is it nice that these are done in percent allocation? Let me open that up before we go further. Why is it nice to have it as percent allocation rather than an explicit dollar amount? Yeah.
Because then you can apply it to any dollar amount.
Okay.
It's a more general solution.
Yeah, it's more general. If you think about this as being a software package that a financial analyst has, they can directly bring this into a client's home or into their business. They can ascertain the risk behavior or risk tolerance of that client, and they can plug in that value directly for that client. And then that client can say, I have $10,000 to invest, or I have $1 million to invest. It will spit out a percentage for either of those clients, and you can multiply it appropriately. So it's much more useful in that regard. So what were the types of asset strategies that we have to choose from here? Percent stocks. Okay, and because I'm writing this rather than on the Excel, I'll use single character, but hopefully use more than single character in your Excel. What should we use for our variable here? I like S. Okay. After stocks?
Bonds.
And what variable should we use here?
W.
Thank you. And next one? Mutual funds. And we can use M here. And then what's the last one? All right. All right. So what is our objective that we're trying to do? I know this was confusing to some of you. What are we trying to solve here? Yeah.
Maximize the rate of return.
Yeah, so we want to maximize our return. I'll just put R here for that. now let's put the constraints in here, okay? So, help me out with some of these constraints. Here, what was one of the constraints?
Stocks have to be less than or equal to 75% of investment.
All right. Help me out with another constraint here.
The mutual funds have greater than or equal to the bonds.
All right. Another constraint over here.
Cash is greater than or equal to 10%.
All right. Back here, what's another constraint?
Cash is less than or equal to 30%.
Any other constraints? No.
They all need to be less than 1,
What
or
needs to
equal
be less than one?
to, percent stocks, percent bonds, percent, all of them.
Okay, yes, so this was the tricky part that is really easy to overlook, because there's no bullet point in here. This is a logical constraint, but it's not the zero logical constraint that we've always put in here. It's a logical constraint that we can't invest more than we have available to us, right? So our totals are stocks plus bonds, plus mutual funds, plus cash. I was just distracted. I'm worried that I'm not recording. I hope I am. That this equals 100%. Right here. All right?
Could it be less
Yes, it could be less than or equal, but in that case, that would be called cash. So actually, that would not be a good solution, because then you could violate these constraints right here. Okay? Yes?
Is the risk value, risk value also a constraint?
Yes. So, we need to be able to compute the risk. So I'll just label it risk here. For part A, it gave a specific risk, and for other parts it gave different risks. So let's do the part A risk to start with. What is that? 0.4. So it's less than or equal to 0.4. So we need to talk about how to compute the risk. I know it was in your textbook, but sometimes that's confusing for some students. It doesn't make sense. So what your textbook had is it basically had a table where it had your asset type, and then it had a risk profile, inherent risk profile associated with it, and an expected return for each one of these types. And so for stocks, what was that, 0.8, was that the value there? For bonds, 0.2. For mutual funds, it was 0.3. And for cash, it's 0, right? You're not going to lose the cash that you stored in your mattress. All right, but then they have different rate of returns, right? So the return for the stock was 10%. I'd love to have that kind of return on my stock. Bonds, 3. Mutual funds, 4, and 1%. So we get a little bit of interest. So we actually aren't putting it in our mattress, right? We're giving it to our bank to do whatever. Okay, so the risk that we compute for this right here is what we're going to do is we're going to take the percentage allocation that we have for each one of these and multiply it by this inherent risk factor right here. So let's do a couple thought experiments. If we invested everything in stocks, what would our risk level be? 0.8, because 100% of our allocation would be in stocks right here. As opposed to if we invested 100% in mutual funds, what would our risk tolerance be? Or not tolerance, but the risk value. Maybe this 0.3. What if we split it evenly? What if we split 50% in stock and 50% in these mutual funds right here? 5.5. Okay, you said 5.5. How did you get that? You do half of it of the risk came from the stock, and half of the risk came from the mutual fund. So 0.4 plus 0.15 for a total of 0.55. So what we do to compute this risk is we multiply this allocation times this risk factor for each one of those values. What does that sound an awful lot like in Excel? When we multiply a group of values times another group of values, and then we add them all together. Sum product. So we're going to hit sum product over and over and over again in this class. You should just start getting used to asking, where can I use sum product for this model? Okay? So, the risk is going to be the sum product of our allocations by the risk. So that's our constraints. The only ones that are missing are, of course, the logical constraints that we didn't enumerate. All larger, we can't invest a negative amount. Okay, what's our return? Let's come back to that. How do we compute what the return, the rate of return is?
You can multiply the percent you invested by the percent return.
Rate of return for each one, and then add it together. You got another sum product. Yes. Yes. Okay. So if you've done this, and this is probably the trickiest one to do if you just looked at the text of your problem, because there's nowhere in the text that says this. And so maybe some of you did this, and I think this one, the answer was in the back of the book, right? So if you look at the back of the book, wait a second here, my answer doesn't match what's in the back of the book, what's going on? If you looked, I think if you don't have this constraint in, it does something like 80% bonds and 80% mutual funds. So that should have been like a warning flag, wait a second here, that doesn't make sense to invest 80% in two different categories, and that should have helped then guide you to meeting this constraint right here if you didn't do it initially. Alright? So always try to look at your answers, even if you don't have them pre-populated in the back of your book, and just ask the simple, does this make sense? Even if I don't know if it's the right answer, does this answer at face value make any sense at all? Okay? And so if you saw two 80% here, hopefully you should be, even if you don't know what the answer is, you know that's not the right answer because of how percentages work. Right? Okay. So you should have computed this, and I think you get something like 5.4% rate of return if you do that. Okay? Now, there actually is an incorrect answer in the back of your book for part B. Okay. Yeah, so if you got a different answer than part B did in the back of your book, it's because the book has an error. And that error extends through multiple editions, too. So, yeah. So I'll skip part A, asking what they're binding and not binding, because that's pretty simple. How do we do that again, real quick? What do we look at to find which constraints are binding or not binding? You look at the shadow price. If there is a shadow price, is it bound or is it not bound? It's bound when it has a shadow price. That's right. Okay, so part B is a little bit more interesting now, right? It says, what happens if we're working with a really conservative investor, right? And they can't handle that 0.4 risk, right? They have to go way down to 0.18. Okay, right? They can't even just invest in bonds here, right? They have to invest a ton in cash in order to get it that low, right? Now, here's how you can help identify that there's an error in your book for part B here. Okay? If we change the right-hand side of our variable, what do we look at what informs us of a change in the right-hand side of the variable? The dual, the shadow price, right? So we can look and say, we changed from 0.4 down to 0.18 for this particular constraint. We're not changing anything else. So that's a change of 0.22. Right? And you can look at your shadow price and see what its acceptable, in this case, this is a decrease, right? What its acceptable decrease is. I think the answer is 0.225. Right? So it just is barely in that acceptable range. Okay, so since it is in that acceptable range, then what we can do is we can multiply 0.22 by that shadow price. Right? And since we're decreasing, what would we expect to happen to our rate of a return? We also expect it to decrease. So you can multiply your shadow price, which I don't remember what the value was for the shadow price. You can multiply it by 0.22, and that's how much you would expect your rate of return to decrease by. Okay? So then you can take your rate of return, 5.4%. You can subtract off this value here that you compute. And what you should see is that that computes to something like, I think it was 2.9%, 2.8%, something like that. Right? And I think your book says that it's supposed to be down at like 2.5 or 2.6%. But you can use the shadow price here to directly prove, without even running it through your model, that this is the actual correct value because it's within your acceptable range for changing this right-hand side value right here. I would double check and I would run it through your model, and your model should come out with the same answer here. But this is a way for when your model says this, and that back to your textbook says something else, this is a second way for you to verify that your new model was computing something wrong and that there was an error in your book somewhere, and you don't bang your head for a long. I haven't found a lot of errors in your book, but this is one that I have found. All right. So that's part B. Part C does the same kind of thing, except I'll do a risky here. It goes up to 0.7, right? And you should compute it. I don't remember exactly what was it 8.2% was the solution for that? Okay. But there's something different about this. In the first two examples, if you looked at what the risk was, we had hit that investor's risk tolerance. In the first case, the risk was 0.4, and our solution ended up with a risk value of 0.4. In the second one, our risk tolerance was 0.18, and we came up with something that was 0.8. If you look at the solution here, that gets us 8.2%, and you look at what the risk value is for that particular optimal solution, you'll see that the risk level is not met. In other words, our investor is comfortable being more risky than our optimal solution allows them to be. Okay? So that's why in question D, they ask, would that investor how would that investor like us to change our rules, our investment company rules, in order for that investor to be able to get a higher rate of return? Because what we see is this is not a binding constraint. The risk is not a binding constraint. Instead, do you guys remember what the binding constraints are for this particular investor? This one, the stocks, and the minimum cash requirement here. So they specifically ask, what if we change this to a higher value, or what if we change this to a lower value? Which would that investor prefer? How do we figure that out? Again, we're going back to that shadow price. We're going to look at the shadow price for each one of these. Okay? And we can quickly look at the shadow price here and look at what its acceptable range is. We would find that the acceptable range for this is all the way down to 0. So we can multiply the shadow price by 10% and get an increase of 0.3. So we can see that if we drop this cash all the way down to zero, so you don't have to retain any cash, we could increase that investor's risk tolerance and return up to 8.5%. However, if you looked carefully, if you did that, that would not raise their risk level all the way up to 0.7. So there still is more risk available to this particular investor that they're not able to access. So if instead we look at the stock, we can see that we can increase this, I forget what the level was, but to something like 85%, 86%, something like that. And you can raise it from 8.2% all the way up to 8.9%. And then you would meet that risk level then, that 0.7 value that we have here. So since lowering this only gets us up to 8.5%, and raising this gets us a rate of return all the way up to 8.9, the answer for part D would be that that particular investor would prefer that we change this particular rule in our investment company because they're going to see the highest possible rate of return for this rule versus this rule down here. All right. Does that make sense? Question. I'm sorry I'm not showing you on the screen, but hopefully you've been doing it on your screens, and I'm confirming what you already did. All right. So let me make a preview then for Monday's assignment. Okay. So if you want to take out your textbooks, 5.3. All right. So this one, if you're not really familiar with finances, or if you look at the question not very carefully, it looks a lot like the question that we just did. Okay. The difference here is that we're trying to decide. Now we've got different investments that we could invest in. And now, unlike the previous one where we made an estimate, we said we think that stocks are going to give this return, or that mutual funds are going to give us this other return. What we're going to do is we're going to look in the past, and this is kind of an iffy proposition here, but we're going to look in the past and we're going to say, how did these particular investments behave? Okay? And hopefully we've got someone who is comfortable with these different investments to say these are typical types of returns that you might see for these particular investments. And what we want to do is we want to pick an investment that's going to have some sort of guaranteed return. Okay? So what we're going to end up doing is we're going to have an investment. Still not a good marker. I'm not going to do the full thing that's in your textbook. So to investment number 1, investment number 2, investment number 3, and so on. And then we have year 1, year 2, year 3, and so on. So we can specifically say that, you know, investing in this S&P 500 stock mutual fund did this, that investing in this real estate investment trust did that, and we could look at those returns. So this year we got these types of returns across these investments. For this other year, we will get completely different returns, or hopefully not the same. Right? So yes, 5.3 I think, or section 5.3. Sorry, not problem, I'm sorry. Okay, so section 5.3 is an example of this. There are problems that do this. Okay, so what we're going to do is we can compute, we want to compute how much of our money to invest in each one of these strategies. Okay, so initially what we're going to do is we're going to use a value, we'll say M. And this stands for the minimum. This is what's called a conservative investing choice. Because what we're going to do is we're going to maximize M. In other words, we're going to say, what's the worst case scenario that could happen to us? These are all the different years that have happened. What's the worst possible standing that we could get with any one of those years? And we're going to say, we want the best worst case scenario to happen to us. We're going to ensure that nothing worse than that is ever going to happen to us. So, so our objective is a maximization problem, but it's what's called a max and min because we're maximizing a minimum. And I'll walk you through that. Yes?
So you're finding all the possible worst case scenarios.
Yes.
And picking a strategy that will have the best worst case.
Correct. So we look at each year. We look at each year and say, for this allocation, year 3 was our worst case scenario. But for some other allocation, year 2 could be our worst case scenario. And so we pick the allocation that has the best worst case scenario for us. So let's walk it through with some numbers here, rather than circles and squares, and maybe it'll be a little bit more clear. So I'm going to pick some easy to compute values. So let's say we get 10% return here, we get 5% return here, and we lose 5% in this scenario right here. Let's say this is really bad. We lose 1%, we lose 3%, but we get 7% in this scenario right here. Okay, and to keep things easy, let's say those are the only 2 years that we're considering right now. And those are the only 3 investment options that we have available to us. Okay, so we're going to have 3 variables. The amount to invest in this, so I'll call that I1, the percent to invest in 2, which is I2, and the percent to invest in stock 3, which is I3 right here. Okay. So let's say I decide to do 40% in these 2, which leaves me 30% in this one right here. Thank you, because I can't add. 20%. All right. So let's look what happened for year 1. Okay, so percentage. So 40% times 10, we got 4. 40% times 5, we get 2. And 20% times minus 5, we get minus 2.5 there, right? We sum those all up, and we get a return. We got a return of 3.5% on our investment. Yes, -1, thank you. So that gives us 5% return on investment. However, in year 2, we would get minus 0.4. We would get minus 1.2, and we get positive 1.4. Did I do the arithmetic right that time? Yes. So for a total of a loss of 0.2. Is everyone following these numbers so far? I just multiplied these percentages times these rate of return. Here's the thing. When we invest in this strategy, we don't know whether year 1 or year 2 is going to happen to us in the future. Both of those we're going to consider as equally likely possibilities. So it's just as equally likely that we get 5% return as we do at losing 0.2%. Okay? So the worst case scenario for this allocation is that we lose 2% on our funds. Okay? So what we're going to do, in theory, is we'll try all possible allocation strategies and we'll look at what the worst case scenario is. Okay? And we'll pick the allocation such that we get the best result from our worst case scenario. So let's try a different allocation strategy. Over here, real quick, let's do 30%, 20%, and 50%. Okay, so we take year 1, we would make 3, we would make 1, and we would lose 2.5. So in this case, we would lose, we would make 1.5%, right? And in year 2 scenario, we would lose 0.3. No, we would lose 3. 30%. 0.2. We would lose 0.6. Right, 0.2 times 3. And then we would gain 3.5. So we would make, in this case, well, lose 0.1. All right, so the worst case scenario for this allocation is losing 0.2%. The worst case scenario for this is losing 0.1%. So we would prefer this allocation over this allocation because this has a better worst case scenario. We're not worried about its best case, right? This has a terrible best case compared to this, right? Here we can do really awesome. But we're being conservative, which I erased up here. We're being conservative, we're worrying about what the worst case is. We can't afford to lose our money. We need to make sure that we don't lose our money. And this allocation scenario is better than this allocation scenario for that particular purpose. Yes, Anne?
How did you get negative funds?
I did 30% times 10, so 0.3 times 10 gets,
Why did you do it?
Shouldn't it be times -1?
oh, I'm sorry, 30% times -1, so that should be
0.3.
0.3,
And you're
thank you.
actually still gaining.
Negative, yes. So this should be positive. Positive 2.6. So now our worst case scenario is here, 1.5. Everything else I said was still valid, right? The worst case scenario here is better than the worst case scenario over here. So because we're caring about that worst case scenario, we would prefer this scenario over this scenario. So what you're going to do when you build your models is you'll build these very things where you'll multiply your allocation times these returns. Sounds a lot like some product, right? Multiply this times this, add it to this times this, and so forth. Okay? And what you're going to say is for that year, it's going to be greater than equal to this M that you define. Okay, that you compute. And year 2 has to be greater than equal to that M. And year 3 has to be greater than equal to that M. And so forth. And then what you do is you maximize M. Okay? And since this isn't a constraint, you can't just give it an arbitrary M, because if you give it too big of a value, then you won't, there will be no possible allocation that that particular year can go above. So that's what's gonna prevent this M from just raising up to infinity, is that you said all of these years have to be larger than this M for each allocation strategy. Okay? So go ahead, work. The other thing is that that same trick that we had for the stocks, funds, mutual funds, and cash, you also have to have that constraint in here as well, right? You need to make sure that these add up to 100%. All right, have a great weekend, everyone. I'll see you on Monday.